Thanks for joining us today on Market Call. I'm Morella Fernandez. Dan Rohinton with us on the show, Vice President, Portfolio Manager at IA Global Asset Management. He'll take your questions on Canadian and global large caps. Here's how to reach us. 1-855-326-6266. You can email your questions in as well, Market Call at bnnbloomberg.ca. Good to see you. Thanks for coming in.
Yeah, thanks for having me.
We have another Middle East deadline tomorrow. The ceasefire expires. I'm wondering if you're seeing the market reaction be more muted now than it was even a few weeks ago.
I think so, but I think it's important to just take a step back. This tends to be the case in most situations. So think about what happened, through the European debt crisis all the way back in the 2010s to where we are today. The first shock is the greatest, and then the market is more reflexive, and basically it acts as a shock absorber the second, third, and fourth time you hear the headlines. I will say, though, it is a bit of a binary because the next stage of this is not just a status quo, it is an escalation from where we are today. So we're talking basically 24 hours before a pretty binary data point, I would say.
Okay, that makes me nervous again. Okay, let's talk about good news already being baked in, which is what you're saying. Where are you seeing that? What good news? Is it earnings you're seeing that's already baked in?
Yeah, I think there's some areas where the market, where, a few weeks ago, I would have been a lot more optimistic. Here it's a little bit more balanced because you're seeing quite a recovery in the market. Just, the breath of relief saying inflation's not going to pick up higher from energy input costs and things like that. So some of the valuations that were 10, 15% cheaper a few weeks ago have started to basically start getting priced in. I would say earnings so far have been pretty good. So in some respects, more expectations, but those expectations in the cases are being met as well, where earnings are derating and making the stocks cheaper on a PE basis.
Okay, let's talk a little bit about companies that can navigate the macro craziness, we'll call it. Are there sector specific? Are there certain sectors that just tend to broadly do better in these times than others?
Yeah, I think overall technology has its own different drivers right now. Also, healthcare tends to be moved to the beat of its own drum. So generally speaking, when you think about big macro sectors, think of your financials, think of your industrials, your energy and materials. The sectors that are left out, like think utilities, think healthcare, think technology, are where they move basically to their own idiosyncrasies. And that tends to mean that whether oil prices are up or down, inflation's up or down, they kind of do their own thing.
All right, let's take a quick break. We will line up the first phone calls for Dan Rohinton, IA Global Asset Management. Again, he'll take your questions today on Canadian and global large caps. Back in a moment. Welcome back. Let's start with an email from Ed. He says, good morning. Could you give me your assessment on WPM, so Wheaton Precious Metals? Does it have legs to go higher? My cost is $175. That's from Ed. Wheaton, like many of the stocks, have in that gold sort of metal, have done very well, come off a little bit more recently. They're more of a royalties company. Would you put more money in where it is today? It's $196.
Yeah, I think the best way to think about the royalty companies, Wheaton is the smaller cousin of Franco-Nevada. The best way to think about them is, are you bullish on the gold price? And if so, then you probably want to own the actual miners itself. Or do you want to have a long-term view on gold where you're constructive, but recognizing there's huge cycles along the way? And that's where Wheaton Precious Metals fits into a diversified portfolio. So do I think it's a buy today? I do, but that's generally a view on gold being a bit more constructive from where we are today than anything unique to Wheaton's portfolio. And what happens in higher gold prices, Morella, is the portfolio reserves expand for these companies. So what used to be not economic for Wheaton's underlying assets, as gold prices rise, that resource base expands. So in gold bull markets, they tend to be lower beta versions of owning the miners itself.
And that being said, because we've seen such a run-up in gold, it's a cycle. Do you think we're in a situation where it will come to that same level again and perhaps surpass it, or you're thinking more of an evening off to come?
I think increasingly it should participate in the upside in gold, but it needs to first start with the metal. And one thing I have noticed is that there's an opportunity. We are seeing more deals in a way that we haven't seen in the last, call it 6 to 9 months. So there is an opportunity to deploy some capital along the way in the case of Wheaton and Franco-Nevada.
Let's get to the first phone call then. Chris is on the line. He's in Delta, BC. Chris, go ahead.
Oh, good morning, Marella and Dan. Dan, always a pleasure when you come on the phone. I always make a point to call in. I'd love to ask your opinion on Canadian Natural Resources. It's in my top 3-4 holdings, along with Pembina, Tourmaline, ARC, et cetera. And it has pulled back a bit, but arguably it was at and it actually trades at a premium, so I'm contradicting myself, but at a discount relative to where it could potentially be trading, especially with higher for longer oil prices. And so, long story short, I'm wondering if you see this small retracement as a buying entry point for a long-term investor. Thank you so much, as always, and I'll hang up and listen.
Thank you for the question. So it had a high of 69.50 in March. Now, as you see, it's tracked back. Would you pick it up where it is today?
I would not. And I say that as someone who owns a stock today, and it's consistently the top oily energy stock in the Canadian basin that I would own for the long-term reasons you would want to own it is disciplined capital allocation, consolidators of the basin, low decline rates, low extraction costs, a lot of things to like. But we have to remember the stock's up almost 50% on the back of the invasion and higher oil prices. So you have to have a view on that to be a buyer today. And I would say directionally, the direction of travel is basically lower from here across the global energy complex. And I think C&Q, although being very high quality, I don't think is a tactical buying opportunity. I'd be a seller instead of a buyer from where we are.
Do you have a forecast for where oil will be even in a couple of months, whether it'll retrace all the way back to the $60 level, or do you think it'll stay sort of more in the 80 range?
I think it's tough, right? Because it fundamentally comes down to, do you think the production that is bottlenecked right now in the Gulf is going to make its way out or not? Or, the inventory make its way out? Probably reasonable to assume that over time. The second question you have to ask yourself, and far more important for the long-term oil price and C&Q, is do you believe there's going to be a permanent curtailment of capacity? Because that's what you need to believe for oil at 100, 110, because you need to basically expect oil fields to be knocked out and take years to come back. That's a bit of a harder call, which is why I say C&Q is up almost 50% since the start of the year. That is a huge rally with some expectation of a higher for longer environment already baked into the price.
Let's get to the next caller then. Amy's on the line. She's in Toronto today. Amy, go ahead.
Oh, hi, Dan. My question is on, in general, the defense aerospace sector in the U.S. I made some money last year with the ETF, and then I sold it, and then I bought another ETF. But seems like this year is just stalling, not doing so well. Do you think this sector could be sort of like a long-term hold? I'd like to hear your outlook on this sector. Thank you so much.
Amy, thank you for the question. So U.S. defense specifically, they're set up to do well, at least in Donald Trump's term, and especially with the conflict going on the way it is now.
Yeah, there's a few things. So when you think about the broader index, when you are buying an ETF, it's important to understand there's a lot of moving parts. So when you think about defense, there's the overall, call it Pentagon budget and global defense budgets, which are significantly rising, and I expect to continue to do so from here. Okay, but then do you want to buy large defense platforms like a F-35 platform with Lockheed Martin? Do you want to buy Huntington Ingalls Industries, which is the aircraft carriers and the shipbuilding? Or do you want to buy the missiles like a Northrop Grumman? That is where things get a lot more murkier, because we are seeing a fundamental bifurcation in how warfare is even fought. So I think there's going to be winners in defense and losers as well. And with a defense ETF, you kind of are along for the whole ride.
Do you think drones are sort of a good investment at this point? Everything does seem to be going that way.
Yes, but drones are, and this gets maybe a little bit too inside baseballs for this conversation. But when you think about drone-based warfare, it's when you don't have air superiority. Because if you are fighting a, call it great power conflict, vis-a-vis what the real Pentagon budget of $1.5 trillion is for, is really just to face off against China. A Russia-Ukraine war and a Russia-Ukraine war versus a China-US war is going to be fundamentally different. So large platforms for great power conflict, micro mosquito fleet platforms for little middle power conflicts like Russia-Ukraine. So all that is to say, defenses, I would be bullish on defense overall. I'd be very careful on where, because great power conflicts are large platforms, and that's where missiles and anti-defense, basically interceptor missiles really comes into play, and those are very different companies. So on balance, I'd say the ETF is probably a buy from here, but with a lot of bifurcation along the way. I hope that all made sense.
Yeah, as you said, there's a lot of moving parts, especially right now. Let's take a quick break. Dan Rohinton with us today. He'll answer more of your questions when we come back. Welcome back to Market Call. Henry's on the line. He's in Vaughan, Ontario, and he has a question today for Dan. Henry, go ahead.
I'd like to buy some Enbridge stock for my TFSA. At what point would you buy Enbridge? Do you think it's pulling back now to a buy point? Thank you.
Thanks for the question. What is your take on Enbridge? We'll just pull up the chart there to 71.15. Do you like it at this price?
I'm a buyer over time. I don't know if I'd really rush into it from where we are today. So nothing's going to truly fundamentally change about the company So think of it as energy proxy, but not directly benefiting from the energy exposure. Like they don't really have a marketing business and anything like that. So I would say tactically wait to see if there's opportunities to get it really below, like call it in the 65 range. But I wouldn't say I'm negative over time. It's just I don't think it's an immediate buying opportunity from where we sit.
Interesting. Wait for it to drop a little bit more.
Major pipelines take a long time to build. There's nothing really in the hopper. Could there be some maintenance and some improvements on some brownfield? Sure. But that's really in the guidance already.
Let's get to the next phone call then. Frank's on the line in Toronto. Frank, go ahead.
Hi, Marilla. Hi, Dan. My question is regarding Honeywell. I know they're coming out with their quarterly numbers on Thursday or Friday, and they also have an impending split in their aerospace division. What is Dan's thoughts on this? Is it a buy, sell, or hold? And what does he think? Basically, what does he think of this stock? Thanks very much.
Thanks for the question. Honeywell, that's what's going to happen this year? Is that the
That's right.
timeline?
Yeah. I'd say, look, splits and call it, divorces like this tend to be a bit of a mixed bag. I think I'm directionally positive on Honeywell, but I would say when you're looking at aerospace, you don't really need to own it through the amalgamation and the hiving off that is the Honeywell assets. You're much better off just owning a GE Aerospace or a TransDigm that's directly going to benefit. So I do think the aerospace assets are the best piece of the overall Honeywell complex. And I think you can probably just get it directly today. But I'm not actually negative on the stock. So if you think Honeywell is your go-to place for multi-industrial that's going to get more specialized, I would say go for it. Do I think it's going to be the next GE where all of the individual pieces ended up being significantly more valuable than together as a conglomerate? I don't. So I don't think it's anywhere near as exciting, but I would say I'm directionally a buyer, but I would also really want to own it for the aerospace assets, which have other public comps already.
That was Frank. Let's go to Faisal. Faisal is on the line in Toronto. Faisal, go ahead.
Hi, good morning, Marilla. Good morning, Dan. Thank you for taking my call. And my question is on Merck. It has sold off this morning. I think it's down like 4 points due to they've pulled the phase 3 trial for their renal cancer drug. Is the sell-off overdone, and is it a good time to step in? I'll hang up and listen. Thank you.
Thank you for the question. Always a good question because you see that sort of immediate reaction and you don't know if it's going to perhaps come back. What are your thoughts on Merck here? Yeah,
I think taking a step back, the readouts are really not the biggest driving force of pharma. And generally speaking, today's move isn't actually all that outsized. What has been going on has been more clarity around pharmaceutical pricing in the United States. And remember, the U.S. is a huge profit pool for all the pharma companies. So that's why that plus 40% is really the story here. And I think what we're seeing is a bit of exhaustion because pharmaceutical companies as a whole and Merck as part of it are actually trading at huge premiums relative to their own history. So I'm not interested in buying Merck today, and I don't think that you should really focus on any individual news story like that in terms of drugs, because the real story has been the big re-rating, which we've already gone through, and I'd be very cautious betting on that future because that future involves R&D pipelines, that type of development, and pharma really is a mixed bag on that. If you want to say what is the greatest pharmaceutical achievement that we've had in the better part of the last decade, it's actually just been, you could argue CAR-T with Gilead, what they bought there, but more likely than not, Ozempic and Wegovy and the GLP-1 complex. But that's a needle in the haystack. So I don't trust pharma for R&D, And I think that the big revaluations already happened, so I'm not a buyer.
Let's get to an email from Brian. What are your thoughts on Broadcom versus Marvell? Would you add to either at today's price? If neither, what would you recommend? So taking us back to the space here, which you were saying goes sort of counter to the crisis, I guess, and the conflict. Would you invest in either of these right now? And if so, which one?
Yeah, so I'll take a step back. I'll explain both. First is Broadcom Technologies, which think of it as the smaller cousin of NVIDIA, which, you know, when you're $2 trillion, but your bigger brother is $5 trillion, that's really that type of magnitude we're talking about here. Broadcom basically is the Google AI program. They build all the specialized chips there. They're increasingly making ways in with Anthropic, which is the owners of Claude. I think Broadcom's interesting, but it's not a, shoot the lights out type of opportunity. I do think I'm a buyer. I'm a directional buyer of Broadcom. I would buy there. Marvell, I would say, is a bit of game theory within the Marvell-Broadcom discussion. Marvell is trying to take a share of the chips that go into Google, and the chips and they're technically part of the program that go into the Trainium chips that Amazon uses for their own clusters.
So it's NVIDIA, Broadcom, Marvell.
Yes, but Marvell being,
much further down,
10 feet, in
the side.
In the room somewhere else.
All right.
I would just say with Marvell, you got to be careful because it's not given that they're actually a capable designer of cutting edge ASICs, the custom GPUs, as they're called. So I would be very careful with Marvell. It's a bit of a coin flip, and that coin has worked out more recently, but we've been hoodwinked before by this company. Broadcom, I'm a lot more comfortable buying, and I think NVIDIA is actually more interesting than both of them.
Interesting. Okay, let's get to one more email then before the break. Max has written in, what is your outlook for CCL, which is Carnival, I guess? CCL is Carnival.
Carnival Cruise, or it's the packaging company in Canada.
Got it. Go ahead.
Well, we can talk cruise lines or CCL Industries, but in the case of CCL Industries, I would just say it's nowhere near the roll-up that it used to be, where they would acquire some of their smaller competitors, and it was highly accretive transactions that they would do day in and day out. I think that story is largely over. Do I think there's a compelling multi-year thesis here? Not really. We can talk about Carnival Cruise Lines as well, but that's more of a, once again, when we talk about the cruise ship industry, really what's interesting there is that cruise lines are cheap relative to other hotels. So going on a cruise is a bargain vacation versus going to an all-inclusive resort and things like that. So I do think the cruise lines are directional buys today, but you have to have a view that oil prices aren't going to stay over $120 and you're not going to see demand destruction, because a cruise ship is a fixed asset where if you lose 5-10% occupancy, it hits your margins harder. I am a directional buyer of Carnival, though.
Okay, let's take that quick break. Then we'll come back with a look at past picks from Dan in just a moment. Stay tuned. Let's get to some past picks from Dan from May 2nd of last year, so almost a year ago. Amazon was the first pick at $189.98 US to $252.04 today, so 33% upside for both return and total return. I imagine you haven't trimmed here. You have just kept what you have. And would you put newer money in today?
Yes. So I think Amazon's interesting. I think when you think about the little, call it the little blip we've had from 240 to 210, that was really when they raised CapEx on AI spending. And then now investors are finally coming around to it. So I think when you think about big cloud and AI as a whole, AI is distributed through big cloud. There's fears and an endless rabbit hole we can go down to other ways that the models will be distilled and dispersed into society. But the way I see it is the best, most common path is going to be through the Amazons, the Googles, the Microsofts of the world. So we're buyers today, and we would stay that way.
Why do you think investors have finally come around? Because it was that huge concern at the end of last year, the start of this year. Everybody stopped buying tech and moved away, and they were like, we don't like what they're spending. We need to see return on investment. Have they started seeing that yet with Amazon?
Yeah, but you know what's ironic about that? From 240 to 210, you were already seeing it. So but I think what you're getting at is actually more of a, call it a human, we're going to go into behavioral finance for a second, where there's this belief where you anchor into prior situations. So when we talk about Iran, what goes into everyone's mind is, oh, the Iraq War. When we talk about anything happen in private credit, everyone thinks it's a great financial crisis. So when anyone thinks about anything technology, the first thing they anchor to is 2000,
the internet, yes.
The internet bubble.
Yeah.
So, things can rhyme, but they're not always the same. And I think this is one of those situations where, despite the data points showing extremely tight demand for hardware already and continuing to rise, investors just said, oh my God, this is just reminding me of Pets.com, Amazon the first time around, so on and so forth. So I think it's more behavioral finance because the numbers the whole way through have been exceptionally robust for these companies.
The sensitivity to it. Okay, let's get to your next past pick, GE Aerospace in New York at 207.70 when you recommended it, 286.47 today, so 40% upside, 40% total return. What are you doing with GE these days?
Buying more.
Okay.
So past pick would be a future pick as well. The best way to think about GE Aerospace as a whole is they make the engines that go into the planes. That's their primary business. And there's two things happening. Demand for new planes is consistently strong as we move to a more experienced economy, post-COVID, things like that. Retirements are very low because the airlines are in pretty strong shape overall. Right now, the stock's actually been 350 to 290. The weakness has come from basically oil prices rising, the fears that jet fuel shortages, things like that. But when you look at the bigger picture, is the trend of air travel going to slow down? No. Are the planes going to be built significantly faster? Loosening up the engine market a little bit? Unlikely. So I'm still a buyer today.
Let's get to your past pick, your third one, Danaher, DHR in New York. At the time, it was 199.05, and now to 193.67, so 2% downside. Same for total return. So they make sort of testing devices?
Yeah.
And what has happened with the space?
Yeah, basically what's ended up happening with the space is that the research and development spending hasn't been as strong as we would have hoped. This is actually one of those stocks we've exited, and we've recycled our weight into Thermo Fisher, which is a bit more full cycle. So it's really little portfolio positioning on our part that we're doing. But when we think about Danaher, what you wanted to own was basically strong, call it mid-single digit growing end markets. And then they took a bit of share. But more than that, they did attractive deals along the way. It seems like their history in the past few years hasn't been that good on doing acquisitions. And that's where we took our mea culpa and said it's no longer in the portfolio. So I'm not a buyer of Danaher today. I'd own it through Thermo Fisher.
Let's take a quick break then. We'll be back with more of your phone calls for Dan in just a moment. Stay tuned. Welcome back. Eric is holding on the line. He's in Montreal. Eric, go ahead.
Yes, it's concerning the ticker BCN. It's Toronto Stock Exchange Index. I want to know if it's good, to buy right now, or should I buy it before or after the Kuzma deal negotiation?
Thank you for the question. Can you tell me a little bit about this? This is the Vanguard one.
Yeah, I think from what I understand, it's just broadly TSX, Toronto Stock Exchange ETF, okay. And I would just say it's not the narrow version; it's the full spectrum of the companies in the Toronto Stock Exchange. I would just say on the question on before or after Kuzma, it just depends on how well do you think it's going to go. I'm not particularly of the mind that it's going to go well, but I would say the most important thing to understand about the Toronto Stock Exchange is that it's not heavily in Canada. So when you think about gold companies, which is I think 18-19% of the market, I'm not 100% sure about this ETF weight, but call it directionally the same. And energy, which is about teens as well, that's a lot of companies where their future has nothing to do with Canada. They just happen to be listed here. So that's step number one. Number two, even the companies that are here, like even the Canadian banks and the life insurance companies, they have a lot of business around the world. So the TSX is maybe 40% Canadian focused, if you will. But directionally, Kuzma, when it does come up for negotiation, the tea leaves and call it the shaping operations that are happening already from what we've seen don't seem to be very good. But I don't think that's really reflected in the market today. So do I say it's a screaming buy? No. I'm directionally not, I would say I would move capital out of Canada, not in Canada. But really, the Toronto Stock Exchange is not the best expression of that. So it's fine.
It's not fantastic.
It's not fantastic, and I would just say directionally, there's better stocks out there in the S&P 500.
Let's get to the next caller. Jack's on the line. He's in Montreal today. Jack, go ahead.
Hi, are you hearing me?
We are hearing you.
Okay, my question is about Canadian banks, and while I was waiting, I turned it into a two-part question. The first is, how high can they go? I was fortunate enough to buy all 5 banks 5 years ago, and they doubled and are on their way to tripling. And I'm saying, how high can they go?
Okay.
The second part of the question is, when they invest in the United States and work as American banks, are they still subject to Canadian regulation?
Yes.
Okay. Thank you for the question. I missed that second part, but let's start with Canadian banks and how high they can go. There's a lot of strength in Canadian banks.
Yeah, and I'd say it's pretty well priced for perfection. So my perspective on the Canadian banks is you're basically paying something on the order of 25-year highs on valuation. That implies very calm seas ahead, if you will. So housing credit issues, none to be found is what's expected. Growth, pretty benign to strong. So that's how you get to 15 times earnings for some of these companies. I don't think that is leaving a lot of room for error. So I'm very cautious on where valuations are, and I'm very cautious on what the setup and the belief that the calm seas ahead is going to be the case.
Does that mean you would trim for Canadian banks right now? You would?
Yes,
okay.
Unequivocally, yes. And then the second point about that is on regulation. So if you're deploying capital in the United States, and are you subject to Canadian rules and regulation? It gets, to save the complexity of the conversation, you basically have a holding company, you have a Canadian division, and you have a U.S. division. Each of these companies have to hold capital relevant and associated with their own division. So TD Bank USA, the Federal Reserve the federal regulators in the U.S. look at only that. So that piece needs to be capitalized adequately. And if we're having capital conversations for any of these companies, there's no world where they trade at 15 times earnings. We're talking 8 times earnings. So I would say this is a problem for 40% down, not for where we are today. Right now, I would just be primarily focused on credit, growth, and Kuzma and how that goes. And I would say I'm significantly more cautious than what the market is pricing in for these companies.
Let's get to the next caller then. Gulam on the line in Toronto. Gulam, go ahead.
Hi, good afternoon. My question is on Propel Holdings. I bought that about 3-4 weeks ago. Not doing much at the moment. Should I continue holding it or should I add to my position? Well, I'd like your view on it. Thank you so much.
Okay, thank you for the question. Clearly, private credit has been a big discussion. Propel has been pushed down on those concerns as well. It's coming back a little bit there, but what do you think?
Yeah, I would just say when you think about private credit, and I believe this is more of the closer to the Easy Home than the Apollos of the world.
Okay.
I would be cautious on these companies. And when you see pressure in one, and especially the low mid end of the consumer base, you tend to not be able to skirt them elsewhere. So when you see, it's called cockroach theory. I think Jamie Dimon talks about it. When you see one cockroach, there tends to be more.
Others, yes.
So I would be very cautious about the low mid end Canadian consumer and their ability to pay. And I think Easy Home, or Go Easy as they rebranded themselves, is a bit of a canary in the coal mine that I'd be very cautious about. If you want to say private credit in the more expansive term of more commercial lending, larger scale, I would look at an Apollo. You don't need to own subprime Canada as a way to earn decent ROEs. You can own it through companies that have a far more diversified asset base. So I would be very cautious on Propel and the whole subprime complex in Canada.
Let's get to an email then from Bob. Bob says, can you comment about owning Shopify versus Microsoft or another Mag 7 stock? Shopify not really considered a Mag 7, obviously, and very volatile, but Canadian-based, which is why a lot of people like it. Would you put money in Shopify over some of the other tech stocks? What would you do?
Yeah, so it's interesting. I'll say Shopify is a phenomenal Canadian success story. One of the things that they are running into the issue when we look ahead, punchline, I think Microsoft's a great place to start. Of the Mag 7, if you want to go to maybe a Meta Platforms, which is increasingly building out agentic AI tools. So the Meta, the social media company that you know of, is increasingly trying to become more of an enterprise tools company. So becoming basically a a smaller, cheaper, small, medium enterprise focused version of Microsoft. I think those are better places to look. And the reason for Shopify is really just taking a step back. They've benefited from the creator economy, the role of social media influencers and things like that. But at its core, it's a orchestration layer and a software layer between drop shippers in China and wherever you make your stuff with the influencers and the users. So Meta is one side, and then basically Shein and Temu are below. Toby's smart, Toby's great, phenomenal Canadian success story, but that means that you are in the layer that is more at risk over time than not. And if I would say Shopify was significantly cheaper, I'd be more interested, but I think Microsoft's the better pick today.
Let's get to a quick break. We'll be back with more of your phone calls for Dan in just a moment. Stay tuned. Welcome back. Tony's on the line. He's in Ottawa. He's got a question today for Dan. Tony, go ahead.
Yes, Rhonda, thank you for taking my call. I'm calling regarding Thomson Reuters. Just some planning for restructuring, and I'm just wondering what it is. If you could comment on that, please, and thank you.
Okay, thank you for the question. So also pushed back by software concerns. I guess whether or not you believe they have that big moat around their data sources determines whether or not you think the company is going to bounce back. What are your thoughts?
Yeah, and I think it's important starting points do matter. At 280 was 50 times earnings. So we have to question whether 50 times was the right starting point in the first place. So maybe not as, say, if we started at 200, not 300, it'd be a little bit less dramatic. Do I think that they are strategically approaching this discussion in the AI, agentic, and distillation of technology world? I don't. I actually think they're making strategy mistakes from where they are today. But there is such a thing as, there's a price for everything in the market. I do think Thomson Reuters is a buy. I would be a buyer today, but I would have to acknowledge that where we are going from here is a significantly worse road for Thomson than where we began a few years ago. And I think the valuation, there's no hope that's going back to 300, anything close to that.
Give me an idea of what strategic mistakes look like for a company in the space.
So what they are is they're basically, let's stick with legal, which is Westlaw.
They're a database, yes.
They're a big database. They'll basically tell you, we have hundreds of years of case law, so therefore nowhere else can you get this information, and every lawyer, you need us. Cool. Don't disagree with that. But let's not forget that you selling and being the point person, basically you being the primary brand that a lawyer goes to and uses for everything, and pulling up the case law themselves, it's being fully abstracted away. An agent is doing that for you. So in 2-3 years' time, a lawyer, where there's probably going to be fewer of them, pings basically an agent, which then goes into a Thomson database, is a far worse value proposition for Thomson when there were more lawyers, plus they own the full stack. So they're getting disrupted in the highest margin parts of their business, and they're becoming what's known as a headless software company, which is far worse than having a head. That's a bad example, but it's software jargon there.
Interesting.
But tactical buy, but I would say tactical buy to 200, not anywhere close to 300.
That was for Tony. Let's get to Anna then in Toronto. Anna, go ahead.
Hi, good afternoon. My question's on Brookfield Corp, BN. I'm just wondering if this is a good entry point and it's a long-term hold. Thank you.
Thank you. I always ask, which of the Brookfields do you like?
Depends on the environment. Okay. Brookfield Corp at the whole is really one step short of management. I would generally say when you think about the Brookfield family of companies, you want to be as close as possible to Bruce Flatt, and that tends to be Brookfield Corp here. I would just say, but take a step back, the recovery in Brookfield that we have seen has outpaced the recovery in some of the U.S. alternative asset managers. So if you have a benign view on private credit, which I do, I would much rather own Apollo than Brookfield today. So if you're willing to step out of Canada, I would say Apollo is a better buying opportunity today than Brookfield Corp is.
Okay, that was for Anna. Let's get to an email from Altino. I have a position in Nebius, and it has been doing quite well. Does the guest think there is still room for Nebius to go up, or is this a good time to trim my position. Can you remind me what Nebius does?
Yeah, it's the NeoCloud. So the long story on this one is that it used to be part of Yandex Group, and it's the European data centers for Yandex. Yandex basically went bust after Russia invaded Ukraine, and then this thing basically got spun out. And the spin out has been actually quite successful because as in the last few years, demand for data centers has gone absolutely through the roof. So if you have chip capacity and occupancy, you become really well positioned there. So I would say congratulations. I would say be careful. This is not a long-term hold because there's a reason why Microsoft is renting from you and not building the data center themselves. You run the risk that you're long the spot market when they own the contracted cash flows. So do I think it's a commodity business over time? I do. Do I think it's the best position in the value chain? I really don't. Do I think tactically it's the golden time to own a Nebius, a CoreWeave, an Oracle? Yes. So tactically hold on to it, but always have one eye on the trigger on the way out.
Would you trim then at the point it's at today? It's at
No.
1.6. You wouldn't. You would hold on
yet.
still.
Not yet.
Let's get to another email from Jean. What are your thoughts on Tourmaline Oil? I'm always sort of hesitant right now to talk about energy because so much has changed in the last 6 weeks, and we don't know what the next 6 weeks will bring. Tourmaline here down on the day, but I mean, look at that spike in the chart. What would you do with Tourmaline?
Yeah, I think if you take a step back, Tourmaline's got great assets. It's well run. It's a prime position in the Montney. Do I think, once again, I always just default back to bigger, more diversified asset bases like a C&Q, and I don't have a particularly strong and constructive view on gas. So I'll take the mulligan and say, I don't really think it's interesting. If you believe that there's escalation coming, it's not really going to come through gas because you need offtake for gas, and it's going to be basically Montney AECO pricing that it's stuck, even if NYMEX is really going crazy. So I don't really know what you're playing for with Tourmaline from here beyond a general tightening of markets, but then over time, you don't have the ability to take it to the rest of the world.
Would you buy in understanding that Canada aims to up its natural gas distribution?
No, because
when
okay. is the question. In 10 years from now, so is LNG Canada going to continue to get fully built out and scaled through and through? That's really what you need to bet on for LNG. But I don't really have a strong view on that. I think I would much rather own C&Q over time than a Tourmaline over time.
Let's get to one more email then before we take our break. Richard says, given the trade uncertainty with the U.S., what are your thoughts on CN Rail versus CPKC, so Kansas City? One goes into the U.S., one goes across Canada. Trade has been tough, right? Where would you put your money these days?
I would say CP for now. And once again, it's a bit of RBC versus TD. It really depends on the idiosyncrasies here and there. But generally speaking, they move in the same direction. I would just say CP has more in its control right now with the Kansas City acquisition and realizing those synergies. But in times when I've been asked about the Canadian rails, there's always the opportunity to own UNP, which is going through its own transcontinental merger. And I think it's important also to say for the Canadian rails, they might not be around in their current form in the next few years because there have been constant rumors, and there's credible reasons to believe those rumors, that these Kansas City will merge with the UNP acquisition as well. So we might see two railroads across all of North America in the coming years. So CN and CP in the future might not be here in its current form.
Just another added question. Would you wait until some sort of agreement comes with the Kuzma deal or some sort of understanding, or would you buy today?
I would be okay buying CP today. CN, it's really a question of, they can debottleneck Prince Rupert a little bit, get a little bit more capacity here and there. But it's really, what are you getting incrementally from here beyond cheap enough stock? So it's not really catalyst rich for what you need in terms of a strong investment thesis. That's why I think UNP is a lot more interesting than both of the Canadian rails. But, it's over time, you're probably not going to be in bad shape buying these companies.
Let's leave it there. We'll take a quick break. We have new topics from Dan when we come back. Join us tomorrow for Market Call. Andre Omelchek will be with us, CEO and CIO, Lion Guard Capital Management. He'll take your questions on North American small and mid-cap. That is tomorrow. Let's get to some new top picks from Dan. We're going to start with Microsoft, MSFT on the NASDAQ. You mentioned this a little bit during the show, but remind us why you like Microsoft out of the tech stocks.
Yeah, when you think about what Microsoft has been going through, is they're basically compute constrained, hence the nebulous comments from earlier. Microsoft is, along with Amazon and Google, going to be the way that the vast majority of enterprises interact with AI, whether it's through Copilot, which will increasingly get better, following the same playbook as Microsoft Teams, which wasn't that great at the start, and then got basically pinched out Zoom and basically owned the communications market. The same is likely going to happen with Copilot, and they have every tool from the productivity suite of software all the way to the communication, the Fortune 5000 lock-in, and the core cloud computing, call it the bare metal compute chips. So they have every right to win in this environment, and you're basically getting this company at a below median multiple for its own history at a time where the reasons you can have gripes on it is that they might lose to Anthropic in the future, but I would take that bet that they have a good chance of winning.
Let's get to your next pick then, which is Taiwan Semiconductor, TSM, on the New York Stock Exchange, which physically makes the chips that get used. Does it have competitors?
Allegedly, yes, but in practice, no. So when you think about Taiwan Semi, there's a lot of competitors in what's known as lagging edge, but leading edge, really the 3 nanometer, the 2, and going sub 2 nanometer, which is really truly deeply microscopic at this point. They are the leading producer, effectively the monopoly. The reason why investors are a bit more excited about the likes of Intel is that there's basically fabs that aren't fully utilized as demand is shooting through the roof. But when you want the more consistent ride in the journey, which is just the toll road on AI and technology getting more miniature, more sophisticated, more demands of it, Taiwan Semi is really, I think, the best toll road in this conversation.
Interesting. Let's get to your third pick then, which is Visa. And I want to talk a little bit more about this one because it's been lagging. It's been going sort of sideways. Same with MasterCard last I looked. And you obviously see some sort of comeback here, but what's that based on?
Yeah, the best way to think about Visa as a whole is there's this belief that agentic commerce is going to mean you don't need a Visa or a MasterCard anymore. You don't need credentials in the way that it existed in the prior world, at the same time as you don't need credit cards in the way that you did in the past as well, which I'd say is maybe. But in the event of a maybe not, you still have a company that's growing 12% revenue, growing EPS a bit faster than that, and an unlevered balance sheet trading at basically a 10-year low on valuation. And you're not counting the fact that they have a chance, every right to win in the agentic world as well. So this is the toll road before Taiwan Semiconductor is increasingly the toll road. So this is viewed as an AI loser, when I think over time, at best, AI is neutral, if not incremental to the runway, because more money movement tends to mean that Visa gets paid.
I was going to say, how would you pay for something if you search through AI? It's got to get you to a pay platform, and you'd have to use your credit card.
The belief is that you use what's known as ACH, which is called the interbank clearing system. So you don't need debit and credit card in the way that you did before. So when you think about Brazil, there's a platform called Pix, which was basically spun up by the Brazilian central bank. And 50% of transactions that would have been otherwise debit are now done basically interbank. So there's real risks to worry about. But when you just think about, do you want credentials as a whole? Do you want to live in a high trust environment when you're talking to an AI agent? There's really no better place than a Visa token. So I think on trust and credibility, Visa has every right to win, although there are risks here.
And the Brazil system is successful?
Yes, extremely so.
Interesting. So you don't need a card, you don't need a number, you just tap in.
It's basically, think of it as like a Venmo, but more sophisticated in that way. But generally, my point being is when you think about payments, the pie tends to just keep growing. So even if you're losing share from an absolute duopoly, which was basically Visa, MasterCard together, there's still a lot of revenue growth ahead. So if you wanted to find a stable 12% revenue grower, there's no better place to look than Visa.
Got to leave it there. We have run out of time. Dan Hinton, thanks for coming in. We appreciate your time.
Thanks for having me.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.